Good morning, everybody. Welcome to the Flow Show. Hope you're doing well this morning. Let's get the screen sharing up and running. Morning, Kay. Morning, Stel.
Morning, everybody.
Hello, TGIF. Happy NFT, not NFT, NFP date.
NFP, yes, that's the one. NFP. NFP. Hope
you,
you're all
Ryan?
doing well. Lots to get through, obviously, this morning. Lots to look at with the NFP. So let's get stuck into it. Going to look at some of the data quickly. Let me just shut my Squawk up. Boom. So let's get into that. It's a bit of data out of China overnight. Services PMI, a little bit softer than expected and prior, but still very positive. Coming into the Eurozone and Germany with a poor reading on factory orders and manufacturing production there. Negative numbers, quite large there for factory orders, down 10.7%. Playing into what we've seen from the German economy recently, particularly in Q1, not looking too hot. Some inflation news for Switzerland. CPI year on year coming down a touch to 2.6% from 2.8 expected and 2.9 prior. So a bit of relief there. We have had S&B's Jordan out this morning saying that they're ready to tighten more if necessary. So that's not off the table. France numbers there, industrial production, again, looking a bit softer on the month. Spain looking pretty good. Look at those numbers year on year, 4.5% versus a minus 0.1 expected there. Eurozone construction PMIs in the main all in the negative there, though some minor improvements for France and for Eurozone overall, Italy as well, but Germany letting the side down on that one. Some retail sales data as well for Italy, flat on the month, but a decent rise on the year versus expected. UK construction PMI, a point better on that one. And Eurozone retail sales worse than expected coming in March. So a bit of a mixed bag of data overall there. Still things not running too hot nor too cold. Right, let's look at some of the other headlines. We had the RBA releasing their statement overnight as well, and they are going to do what is necessary to return inflation to target. They see some further tightening may be required to reach target in a reasonable time frame. Coming over to the ECB, and we'll have a big chat about that as well, but we'll look at just quickly some of the data that came in yesterday, a couple of pieces. Challenger grade jobs came in, and that showed another jump coming in at 66,000, just under 69,000 versus just under 90,000 last time. So still running at some quite high numbers there. Retail was the main loser in that one, where these job cuts have been announced, which is a bit of a switch from some of the tech jobs that we've seen being laid off recently. Coming over to the Bank of Canada, and BOC's Macklem expects inflation to fall quickly this summer. Says if we start to see signs that inflation is likely to get stuck above target, we are prepared to raise interest rates again. It's too early to be thinking about rate cuts. We paused, but that doesn't mean we are at the end. US banking has become a bit of an issue again yesterday. All sorts of stories flying around. The FT dropped a piece saying that Western Alliance were considering its legal options and the possibility of a sale. That has since been, or that was dismissed quite strongly by Western Alliance, saying it's a complete fabrication of a story. And indeed, they're looking at now legal action against the FT for dropping that on them. So that's going to be something that develops. That hasn't stopped the market from getting anxious about the US banking system again. A US Treasury official came out saying they are continuing to monitor market developments in the regional banking sector. The US banking system has substantial liquidity and deposit flows are stable. The FDIC is apparently going to hit big banks with fees to refill the deposit insurance fund. So if they get hit with fees, they're likely to get passed on to customers. That's something else to consider in the inflation pot as well. So despite everything going on in the US banking world and the worries therein, the numbers were out from the Fed and their discount window borrowing. This is all the emergency liquidity that they've been providing. In the week to April 26, 73.9 billion was taken out of that window. Last week, that dropped to 5.3 billion. So a big, massive drop there, which suggests that despite some of the headlines we're getting and the market getting a bit antsy over US banks, beneath the surface, they're not borrowing too much money to, keep liquidity flowing. But we'll keep an eye on that one. Either way, right into the big one, the ECB, and we got a 25 pip hike. As I expected yesterday, there was a bit of a concession given to the doves by the hawks in going 25s, in that they will get further hikes. So they hiked by 25 pips. They expect to stop at APP reinvestments at the end of June, beginning of July. ECB's Lagarde, in her opening comments and questions, said that domestic demand and consumption remained weak. They're seeing divergence among the sectors of economics. They're seeing divergence among the sectors of the economy. Manufacturing prospects are worsening, so they're picking up on this divergence that we've been pointing out between things like the PMIs. She said price pressures remain strong. Wage pressures have strengthened further. Longer-term inflation expectations warrant monitoring. And today we did get the release of the ECB Professional Forecasters Survey, which on the longer-term numbers saw both headline and core unchanged at 2.1 and 2.0. There was a little bit of movement about in the each year forecasts, going down a bit on one, up on another, but largely remaining unchanged. So back to Lagarde, and she said that everybody agreed that raising rates was needed and that we are not pausing. We have more ground to cover, and that it was sensible to return to a more standard increment. The rate hike process is a journey and we're not there yet. Not making any commitments to rate cuts at this point in time. Just after that, or later on, we got the ECB sources, as usually we do, about an hour, 2 hours after the meeting. And apparently the sources said that policymakers reached a deal on a smaller hike in return for guidance for more hikes ahead. Some policymakers see 2 to 3 rate hikes ahead. As I said, that was what I was expecting from the ECB, that they would drop to 25, but signal that they were nowhere near a pause and that more hikes would be coming. Now, one little thing that became a little bit of an item to look at. Lagarde was asked a question by a Japanese reporter about her visit in Asia, and she got a little bit tongue-tied, and it almost sounded like she wanted to, in saying something about UEDA, almost sounded like she wanted to say something about how policy is changing, because she said that they are moving into a new direction with a new governor. Now, I took it as saying she nearly slipped up and gave an indication that policy might be changing in Japan. Others have different opinions. If you watch back the video, and you can find my tweet of it, it was a very hairy moment for her. She really did struggle with that one to get her words out and in order. So probably nothing, but you never know. It might be something. Just before I get the guys' input into yesterday, we've had obviously the floodgates open on ECB speakers. ECB's Vero said the change in rate increase rhythm is an important signal, and he favours smaller ECB rate increases, and that there will likely be several more hikes. ECB's Vasley said further steps will depend on economic data. ECB's Simkus says Thursday's rate increase wasn't the last. ECB's Muller, no one knows how high rates must be raised. There's no sign yet of a clear slowdown in core inflation, and that the latest interest rate increase won't be the last. Now, for me, I think we've probably got 2 or 3 more in the pipe for the ECB. I think if we're around between 4 and 4.5% for rates, that's going to be their pause level. I can't see them getting up to Fed levels unless inflation really does start ramping higher again. So perhaps maybe the market is starting to smell the end of the ECB rate cycle, or pausing it, given what we've been seeing in the euro pairs thus far. So guys, who wants to go first with your review of the ECB?
Whatever you guys want. I can go first.
You've got it now. You spoke first.
I got it. Well, I think you covered it well. There was a kind of a trade-off between doing 25 and guiding for more. The worry that I'm sure the ECB have, and they are already discussing it, is the prospects for the Eurozone economy, and for Germany in particular. I mean, we're seeing numbers which are starting to look pretty terrible. I don't know if you saw factory orders today cratered in Germany. And also Eurozone retail sales were a lot lower than expected. So they have a very tough job to do, same as the Fed, same as everybody else, control inflation while not killing the economy completely. And unfortunately, I don't think they can do both. Actually, they can succeed on both of those goals. So they have to, at some point, make a decision. Do we allow inflation to stay higher for longer and let it creep lower eventually, and try to save the economy, or save a recession, a deep recession, or do we just keep going, bring inflation down, but then face the consequences? So I think the ECB is trying to find some kind of middle ground, but I fear that they're going to be they're talking the talk, but I think they're going to be pausing relatively soon as well. They're going to be following the Fed's footsteps pretty soon. I dare say I think there's one more 25 and they're going to be done, even though inflation is high. And I think the economic background will dictate that. I don't think it's necessarily the right thing to do, but I think that's what the ECB and Lagarde are going to go for, simply because they always have a bias to not tighten if they can. You know, we've seen this pretty much everywhere. So, you know, reading what they've done, what they did yesterday, I think it was a dovish hike because they hiked. There was a chance they might be doing 50. They didn't. And yes, they are talking about doing more. Yes, we're not done yet. But, you know, that's how it begins. You first drop the pace of the hikes and then you stop. And remember, this is what we're talking about with the Fed as well. Remember when they were doing 75s and then they went and they did the 25. Eventually, they did the first 25 and people were saying, no, they're going to keep doing 25 every meeting for the next year or so, you know, keep inflation control. Well, no, I think that's the first step. You know, reducing the pace is the first step, and the second step, which usually follows relatively quickly, is to pause. So that's my view of it. So I make it a dovish hike. And yes, there's still a divergence between the ECB and the Fed, for example. I don't know how much longer this is going to continue, though, this divergence. I think the ECB is close to pausing as well, even with inflation up here.
Yeah. So Stel is a one and done man in that camp. Kay, what's your thoughts?
Yeah. So I said yesterday in the room that I thought it was a mildly dovish meeting, and she was trying. Really, I said a couple of times, I said, who has put Lagarde's voice onto Powell's presser? It was like she was trying to do exactly the same as he did, like trying to be as neutral as possible and then covering all the bases. The one thing that could have been interpreted as hawkish and we go on, and she said that a couple of times, that they were still on a journey and not yet, they don't know when the journey is going to be finished. But over the last meeting, the meeting before, they were pretty adamant that they were going to continue to raise rates. Now she did leave the door open for a pause and go completely data dependent, and that that is something that she said as well. And as I said in the room, it's rather than being outright bearish euro dollar or so, it could weigh on the euro crosses that have been so big going into the meeting, and also over the past month and a half, 2 months nearly. Euro crosses have really been very big, and as a matter of fact, I mean, most of the euro crosses didn't see a meltdown, but a decent setback. Japanese yen is one, but then there's other stuff playing in the yen. But yeah, as you're doing the rounds there, you look at euro sterling going up on the head, is about 0.5% lower. Those euro Kiwi, euro Aussie, euro Canada saw a decent setback as well after the ECB. And then now it all depends what's going to happen, or where the market is going to find itself versus, yeah, this is a pretty nice one as well, the euro Noki. Where the market thinks that the ECB is going to be at. So as I said yesterday, this is a mildly euro bearish, euro cross bearish. It happened, but I wouldn't call it outright a bearish euro dollar, because we have the Fed on the other side. The euro dollar is really something to be taken apart, to be taken aside of all the rest. So that is it. I think she or all the members, as you rightly say, the 25 is a concession to the more dovish side. We've heard so much about all the hawks over the past months, and now they've gone a little more quiet. Of course, they can come out of the woodwork again and start to push for more hikes, but it is pretty clear. And now we're going to look at data again, and if it's pretty clear that the data in the main countries, and take the biggest one, Germany, are showing signs of slowing down, or seeing a bit more negative prints than somewhere else. The southern of Europe is actually doing pretty well, but those data can be much more jumpy than the main countries, and Germany as an example. So we're going to have to see and wait and see what's happening there. But yeah, I mean, that's it. It's a neutral to slightly dovish meeting, but then you have to take into account what happens again if we talk about trading the thing. What happens again on the rest of the currencies, right? I mean, Euro CAD was one that I was highlighting as well yesterday, and it did collapse quite a bit, but also helped by the fact that the oils are a little bit higher again. So, and we have the Canadian labor report out later. I'm sure we're going to cover that as well. It's I don't know. I mean, yeah, you have this white line over there. 148 is a pretty decent setback if you look at what happened over the past days, weeks as well. Okay, we've had the big one, the big rally there from September, but even if you take it from the 146.5 there, just the latest one, end of April, that last spike high. If you get back to 148, for instance, that's, I think, whoops, what is happening here? I think that will again be a time for reflection. Even, I don't know what's happening here with my trading. That's my, those are my trading applications. I'm sorry, guys.
So your algo's going off.
Let me just close them. Here we go. There's another one. Yeah, okay, later. Sorry about that, guys. So yes, I was saying, so perhaps around 148, it's time for a bit of reflection, because we just don't know. It's too early to tell whether the euro is really done with everything and starting to go down. But as I said, we could have seen the peak of the euro crosses over the ECB, and that's what I said already a couple of times over the show. So I'm going to keep a very close eye on things. I'm in a bit of dollar Norway short, that, yeah, but then I've just jobbing in and out of euro Norway short as well right now. The euro CAD is one, but it's really faster stuff, so I'm not really updating too much on it, because before I can update it, sometimes I'm already out. But I'm looking more at a little more downside from here in perhaps euro crosses, and then reassess. You know, it's not as if we are done, because the ECB can continue to hike. And if you were talking about what do we think, one and done or more, I think 2 max. Where are we now again? 3.75 or 3.5?
3 3/4.
Yeah, I think 2 and done. 2 max for me. That's going to be, if I need to put a number on the hikes, it's 2. And then done, and see what happens, especially if we continue to get those data, right? Coming in a little bit on the weaker side. That's it for the ECB.
Cool. Thank you very much, mate. Yeah, I'm probably in the 2 to. I'm probably in the 2 camp with a good chance of 3 if inflation remains sticky and that core remains sticky. But I think over that it's gonna take a lot for them to go past that. I think so. You know, never say never. We've seen some fun and games in the inflation data, and the economy isn't doing too badly. You know, obviously Germany is a big manufacturing hub. That's suffering. Services is a bit better, not as good as some of the other countries. But yeah, it's, you know, as we've been saying for pretty much this year, not going to expect boom times, but not going to expect bust times either. So a little bit of scraping along at the bottom, as we say.
Ryan, just want to say one thing. I just want to make it clear. I think the right thing to do probably is to do 2 or 3 more until at least inflation starts coming down more. But I just don't trust these central banks. That's why I think it's going to be one and done.
I get it. The ECB are always going to be far more cautious than others. You know, it's always been their nature. It took them kicking and screaming to go into hikes and turn hawkish. So we know. Plus, you know, we have to understand also that it's a far different situation to any other country. Now, other central banks are just dealing with one country. Obviously, the Eurozone is dealing with, 18, 19 now? However many more they've let in. So, you know, there's a consideration for all the countries, not just one. And that obviously plays on their minds too. And yeah, I just wanted to say we have had the UK elections, which has turned into a bit of a mess for the ruling Conservative Party. They've taken the expected hammering, though not that we've seen anything really in pound pairs that I could pull out and say was a direct effect of the election. Again, these are not MP seats, so not parliamentary seats. These are just people going on councils around the UK. So it doesn't change the political landscape in terms of general election, that sort of thing, or seats in Parliament. It's all for councils, but it's still seen as a bellwether for how the parties are faring, and the Conservatives are doing badly and Labour's doing better, and the others are muddling along with some modest gains themselves. Right, so let's have a quick look at what's coming up today. Obviously, we've got the big old NFP and its double bubble, as Kay mentioned, with the Canadian jobs report as well. So we're expecting round about the 180k mark expectations for the NFP following last month's 236, which was a bit of an upside surprise there. So as usual, the 4 things to watch. Obviously, the headline number, first and foremost, to see what that is. Secondly, watch the unemployment rate. When that comes in, that's there. Expected to tick up to 3.6%. But when you look at that, you have to look at the participation rate, because that can affect the unemployment, or does affect the unemployment rate. If the participation rate rises, that could mean the unemployment rate rises. Because more people not in the jobs market are coming into the jobs market to look for work. They still are unemployed at that point, so it adds to the unemployment rate. So for this to go, if this goes up and this comes down, okay, it means that's negative. It means there's people coming out the market, but still more people becoming unemployed. So good news would be that this goes down even while this goes up. So unemployment rate down, participation rate up, makes that between both of them a good set of numbers. From there, obviously look at the wages. So the average hourly earnings, I look at the year-on-year number, 4.2%. Expected in unchanged there. So this is your inflation number for the Fed. So if it's much higher, obviously that's inflationary pressures coming in. If it's much lower, then that's inflationary pressures dropping out. And then you look at that compared to inflation to tell whether wages are a plus, real wages are a plus or a negative after you've taken off inflation. So look at those 4 key metrics to decide. So sometimes we can move quickly on the headline number, then the market looks at the other details and decides, are those better or worse, and do they overtake what the headline number was, and then the wages as well. Considering everything's about inflation, the wages are an important number there. And then for the Canadian jobs, we have been seeing some pretty big numbers coming out. Expected to be a more moderate 20K from 37.4K prior. For this one, again, you can watch the unemployment rate and participation rate. Also watch the what I call the revolving door, the difference between full-time employment and part-time employment. Big job gains in the headline number can be countered somewhat if they're big gains in part-time, and for example we see full-time dropping. What you want to see for a more solid looking jobs market is a trend up in full-time employment rather than moves in part-time, because obviously full-time is more solid. Guys, you got any expectations? What were your calls in the NFP competition?
Wow, I'm going first because Stelios stole my my
Here we go.
What did I do?
You stole mine because you always try to be like very close to mine. So you went for 112, where I already announced, I think very early in the week, that I was going to go for a 111.
Seriously, I don't remember that.
Yeah. Yeah, but you Greeks, you only remember what happened.
It's
a good job we're not competitive about this.
I will retract it and then put another number.
So yeah, I'm absolutely right on the how to look at those NFP numbers. The one thing that I noted during Powell's speech is that he said that they are seeing some of the imbalances in the labor market being corrected. Now, if that would have been Trump in the old days, we would have known that the labor report in the States would have been a crappy one, because then that he means by the imbalances, they say they wanted the imbalances to see reduced, and I just took note of that line. Because I find it a bit of a strange one, because we haven't seen in the official BLS reports like this one, the NFP, anything of a slowdown. But he comes and he sends that line into onto the waves, and that was a bit of a strange one. So I wouldn't be surprised, let's put it that way, to see a weaker one on the US. And we've been saying that nearly every month, and say sooner or later it has to correct, because so far we only had beats, right? Compared to what may have been. So yeah, I'm going to go just sticking my neck out for a little bit of a weaker one. And then on the Canadian, yeah, that's what I've been saying since years. You have to look at the difference between the full and the part-time employment for the viability of a move in Canadian dollar post headline move. So if you get a number as expected, you have to look at the balance between the full and the part-time employment. And there I'm going to to send one to Ryan. You've stolen that one from me. So so now
I stole what one from you?
Now I've sent it to both of you.
What have I stolen?
The balance between full and part-time.
I've been watching that for donkeys. Yeah, that's why I call it the revolving door, because one day you're getting up 50, then you get down 50, and there was times when it was completely, 1 minute, I say full time would be up 50, the next month down 50, and you couldn't make head nor tail of the trend in that one. But anyway, no one's thieving anything around here. Much.
I'll keep it to my own view. And so. Yeah, basically, are we finally going to see that slowdown? Is still the big question, right? For this afternoon.
Well, if we keep saying it every month, one day we'll be right.
We will be spot on. We will be spot on.
And then we can say we told you so, even though we had to wait 10 years to do so.
I told you so's coming. Okay. I mean, this is really it. If it holds up, then we are going back to the yields watching, and we're on a little bit of an interesting level there in the tens, and I'll show that in a bit. There's a bit of a trend line coming in there, we are on it. And then basically you look at the 325 and there or the 350 or above, right? And that's going to, in the short term at least, tell us whether this dollar is holding up or whether it's going to go into a very difficult end of the week.
Yeah, I think once again that where we close today is going to be very important. I'm expecting any good numbers from the NFP to be sold into, particularly in the dollar, just because that's the mood it's been in. We've come through ADP, we came through the ISM services, we came through a Fed, and the dollar's been sold each and every time. So until something changes, and it's likely going to be yields that do that, I'm favouring for the moment that dollars are a rally sell for now. As we know, that can flip like a light switch. Now, obviously, one pair to look at throughout this is the loonie because of both jobs reports. So really, you've got to be careful with this one when both reports are out, because obviously what happens in the dollar can outweigh what happens in the CAD. So be very careful with this. You may get a really strong Canadian report and you see dollar CAD dipping, but then if the market says, oh, well, hang on, the US report is much better, then it rises. So that's more so where the crosses may come into it, where CAD may be reflected. So look at things like CAD yen because of what the mood is like in the yen at the moment, which I'll let Kay look at the cross stuff. But for the loonie, it can be a bit of a neutral reaction in it, depending on, as I say, who's strong, who's weak. Obviously, if you get numbers that are weak in the US, strong in Canada, then obviously you're going to see the loonie fall, and vice versa if the numbers are opposite that. For this one, I just tend to keep an eye on the wider ranges, as I have been doing forever. Anything up towards the top end is where I'll be looking to potentially fade a move, and anywhere down towards the bottom end, the same thing on big numbers. Obviously, you've got some levels in between, 136.5 here, and down into 135, 134, 70s, 60s, that sort of area there is somewhere to look at. But just be careful if you're trading a loonie over this one. Kay, do you want to have a quick look around?
Yeah, perhaps let's still. I don't know what you're thinking about the labor reports this afternoon. Still.
Yeah, my view
on. If he's copying your charts, mate.
Well, I think I have the right number. No, I'm changing mine to -112. But no, I mean, you know me. I look at the big picture, and for me, the big picture means or is showing that the labor environment is shifting, not in a good way. Will it be, today a weak number? Of course, you can't time this, but you look at jolts, you look at companies firing left, right, and center, not just in the US. Volvo was announcing yesterday, highly profitable company, the past decade or so. They're laying off people, so it's not one specific sector or one specific country. It's a general trend which will continue, I think. So my view is that the labor environment is going to get worse. Hence, I'm going. Yeah, Bran. Hence, I'm going for a weaker number. But we saw ADP come in stronger than expected, so NFP could easily do that. I just think the trend is lower. That's why I have this bias. But other than that, we definitely need to look at the participation rate and average hourly earnings. For me, earnings is still one of the key numbers, because earnings rising have a secondary inflation effect or dropping as well. So I think that's still a key number. For me, the earnings number is more important than the unemployment rate, because that's going to be 0.1 here, 0.1 there. It doesn't really make a big difference. But I am definitely going to be watching the hourly earnings number. But apart from that, I just think numbers should theoretically continue to be weaker on average. Not every number, obviously.
Yeah, it makes sense. It makes complete sense. Right. So let's start with the euro crosses, right? So as I was saying yesterday, ahead of the ECB, that I thought the ECB may mark bit of a top on the euro crosses. It seems to materialize there. If you look across the spectrum, apart from Euro Swiss, because the Swiss is a completely different animal than all the rest, most of the euro crosses are lower. So first of all, and this is going to be an important one going into this afternoon, of course, because that is where we get a confirmation or not about whether this is going to continue lower. I'm also looking at what's happening in the oil market, and the oils are trying to recover a bit. I see the crude the WTI is up 2% in the morning. Brent is also up about 2% this morning, and that is gas is also up. So that's helping stuff like the Canadian dollar and the Norwegian kroner, what I'm going to show in a minute. So what's happening over Canadian Labour Report? If you get a good one, then we are really going to put big pressure on this 148.5. We are about 40 points above there. That, in my opinion, on a very good labor report in Canada, this is going to give way. And then we are looking at what Ryan also showed there, this 148 zone. It's called it's a bit of a zone, right? It's 147.9510 roughly. And then we are going to look at what's happening here around this trend line, and they're all not too far away. This one has been run over a couple of times. I'm going to take that out. They are not too far away either. You're talking about 147.5, and I think that's going to be. It looks to me a little bit like the do or die zone. Until then, because we can go further back, it's been really like trending up very, very, very strongly. Until then, I'd say this could still be only the correction off. Let's try to put what this one is going to give us. There, that's 147.80, not too bad. It's there as well, 38.2. So this is going to be your zone of mega importance, I think, on the EuroCAD. This one is to be really monitored closely. If you go back up, then we're talking about high 149s, bit of the 150 psychologically in there. That's going to be your resistance area now, 149.70, 150 the figure. So you've got those levels to play with if you want to trade some EuroCAD. Again, I really think this is still a short-term play unless we see the rest of the European data starting to deteriorate, and then we can have a bigger setback. Until then, I'd say this could still be corrective. Okay, but let's see down to where we can go in this one. Ryan already showed Euro Yen. Yeah, again, we did not reach the target of this possible longer term trend, but yeah, we had this big rejection, and then we also yesterday after the on the ECB we had the break below 148.5, 148.35. That was one that I was highlighting before, the prior top, and we're trading well below, trading through the trend line as well. So depending on, this is one that's going to be driven by two things. Of course, the yields, there's no question about it, but also risk. If ever we would close this week on a very weak risk pattern, we could really see this go further down. 146.80 should really not be ruled out. But why not even deeper if the risk pattern is really crappy. Top side now, have a look at what's happening around 148.35.65. If we get back above this here, this 148.65, then the correction may be over, and we are going to target back those higher levels. I'm relatively neutral on what yen is concerned right now, because I have an issue with buying yen for a longer period because of the funding. I don't like to pay away funding, certainly not for more than a few sessions. So I think we're in a bit of a relatively important area coming up here, just below 134. And then you have a few parallels coming in here as well. This one is around 133.20. This is our prior low. I think this zone is going to be relatively important if you take away all those trend lines. 133 figure, 132.75. You've got like 25-30 points here, which are going to be important. Prior low, a bit of a defense zone as well that we've seen in the past. That's going to be an important one closing the week or starting next week. If in turn we get a very good report out of the US, that should actually be pretty good for risk and send those yields back higher, in which case I think we may be in for a retest of the 135.10 for a starter, stretch it to 135.40 perhaps, and then we see what's going on there. It would take a very strong report, in my opinion, to go back to 136. But yen has been volatile in over the past weeks, even months. So I wouldn't exclude too much, because seeing the mood in the market right now, if you get a really good report and not a lot of other crap out of the banking system or another or the debt ceiling or whatever, it could be that the market says like, oh well, okay, we've hammered risk enough. We have to have buy back dollar yen or sell yen in some form. I think Ryan already showed it, but yeah, euro sterling, we are below this trend line here, right? Around 87.75. Yesterday, as I said in the room, I think this euro cross maybe sort of ran its course, and sorry about that. And sterling was doing relatively well. I've been saying that for sessions on our own now. Sterling is doing pretty well and shrugging off everything that can come out of those local elections as well, which is a tad surprising, because sterling, as we know, is a currency that runs on emotions a lot of time. It's a pretty emotional currency, and no one cares about those local elections, it seems. So we've fully traded the ECB, and euro sterling came back down. I'm out of my shorts because I don't know how much further the euro has to run, but yeah, if you look at the cable today, we are breaking above this, trying to break above this channel or wedge, and any hiccup in the NFPs this afternoon is going to open the possibility to test the 127. If in turn we get a good report, this may be a failure here. 125.90 is your nearest mark. Yeah, I know, Mike, about the debt ceiling, maybe even July, you know. Yeah, 125.90 is your first measurement point. If we get back down there on a very good report, then it should, or we could see a test back down to low 125s, or even our big magnet point again in the 124.40.50. But therefore, and that's going to be valid for all the dollar pairs this afternoon. Therefore, we need to get a monster NFP this afternoon, a real monster NFP to take it back down there, because the mood is just not there for the dollar to trade much higher in current situation. But never say never. So that's the trend line I was showing here. It comes back from early 2022, and we are on it on the 10s. We've dropped below on those worries about the banking, the regional banks, and everybody banging on about the debt ceiling. There's still, I think, still a 99% probability that it gets resolved. But if you're with a hung parliament, it's really a difficult one, and those people really like to put on a show, and it's probably going to go to the 11th or even not 1 or 12th hour. So this is where I think it's relatively important to get the close for this week. You can see this here as well. We've been trading around this 337.38. That's going to be the first one, if we are above here or not. And then you talk about 350, 360. A very, very good report will put pressure again on this 360. But that's going to take an outstanding report. On the other side, there we are. If this would be a crap report in many senses of the not only a mild miss, okay, I think everything above 100K, around 100 or above, is going to be good enough for the yields not to completely fall out of bed. Could be on the twos, might be a bit more volatile, but look at the tens, because that's still your main dollar yen driver for instance. 3.25, guys. If that goes through, I know the 38.2 is 320, but already through the past low, that will mean that something's really wrong and that the market is hammering. And then I would really think that the dollar comes under a lot of pressure to end this week. So those are the levels here for this 10-year on the dollar. I want to have a look at this Norway, because as Stel and I and other people in the room as well, we were very, very closely watching what's happening in the Norway. And here you have it. Thursday, 4th of May, we hit a bit of a high in the early morning. It's actually Wednesday night, early morning on the Euro Noki. And here we go. Right, I think we may be in for a bit more correction here now, especially that I'm looking at those oils and gas prices, and they are ticking up a little bit. We are on a bit of support here. That's what I was saying in the room as well. 1170 was a bit of a zone here. If that gets through, then I think there is, why not, a decent possibility after the ECB yesterday to go for another 1 or 2%. It's been relatively volatile as well, so I really wouldn't rule it out. Close the week back above 1170, then your 1170 is going to be viewed upon as your prior 1120, in my opinion. Yeah? You make the high, then you hold, and we get those bounces. Here we are again on it. Call it 1169. We are on it. It's going to be an interesting close. If we close the week below, then I really think we have a chance to get down to low 1150s. Dollar Norway, I'm short, a little bit short. Sold it yesterday against this trend line, and it retested a couple of times when oils were doing their lows, but then the dollar not having enough strength. It's finally starting to come back down here. Happy about that. I've already taken a bit off here. need to reduce the risk into the NFPs this afternoon. But if you get a mildly weaker one on this one, because I say mild, because if we get a real crap report, I think that oil could actually dump if you get a really bad report on the labor market. So this will make this pair, probably Euro NOK jump again, but this pair are actually more difficult to go down. But if you get a mild miss, let's put it that way, then I think we are going to end the week up closer to 1050 here. And why not at the start of the week look at deeper levels? But that's music for next week. I think if we ever get anywhere close to this 48.51 zone in the dollar NOK, that should be kind of enough. Sterling yen. Where are we? Here. Yeah, double top. Huh? This is a daily, okay? We can look at it closer, but yesterday I was talking about this 168.5. We had a bit of a drop below, but we never closed below. So your 168.5 is still the level to watch to close the week, in my opinion. If we start to get lower, that means that risk is not feeling well at all. But for the time being, we must admire, or I was going to say, we must admit that sterling is behaving pretty well. So I think this is already a good enough marker. If we go below, then it's probably 166.5, and if that weren't to be enough, 165.40. That's going to be the big zone somewhere that needs to hold, or there is a change in this pattern, in my opinion. Top side, we are somewhere around here, 169.30, but then you look again at 170, I think, and perhaps back at your prior highs. But in the state of the market right now, I doubt it would be surprising that we break above this double top just to close the week, because I don't think that risk is just strong enough. Because sterling yen is really a big risk pair, right? And I don't think that risk is that strong enough just to take this higher. Last one, yeah, this gold spike, forget about it. I think that's really an algo miscue, fat finger or something that happened there. But look at how this will close around 2030 for the week. Below is probably it's probably 20-30 bucks to the downside. Keep above, then it's 2048, 2050, right? The one that I'm really interested in to close this week, I did sell a little bit more of my 2460s ads. I must repeat that Stelios called that one here like spot on nearly to the pip.
Did he copy you, Stel?
I copied him. And I said it straight away. I say because I was bidding 2048 that day, and seeing Stel, then I opened the chart and I went like, yeah, all right, this is the level. So I did, and I did give him the credit. The next
I have to admit, right? I always feel better when Kay is agreeing with me. So it was nice confirmation.
Okay, that is great. Yeah, so today I took a little bit off. We have to take a bit of profit ahead of events, but I'm ready after the labor report. If it spikes to buy it back through 26, 25, 30, I think we are going to be hitting 27 rather soon. And that's it for me, Ryan, for today. Over to you.
Thank you very much. Shall grab the screen back, because I feel I've got to address a grievous slur against my good character and good name regarding the Canadian Labour report. There's a post from 2015, where I talk about how the full-time, part-time situation is clear as mud. So there it is in black and white, just to address that terrible slur against my name. Oh, disgraceful. I'm nearly calling up my lawyer over that. But a couple of other points.
We didn't know each other in 2015, so I'm not going to even
That proves
reply.
my case even more. So no. Anyway, just a couple of other points. There's no flow show on Monday because of the bank holiday in the UK for the coronation weekend. Also, May 9th is a date for your diaries. Talking about the debt ceiling, I saw Mike talking about the debt ceiling there, because we supposedly have this meeting of all the house leaders and bods in the know and whatever in the US, sitting down with Biden to discuss that, which may bring some headlines. Also, it's the V-Day, Victory Day celebrations in Russia that's caused a bit of issues with those headlines about drone attacks and stuff. That's May the 9th as well. On the risk point of view, Russia will want that to pass fairly quietly on their shores, but we perhaps should think about a potential risk event happening to do with the war if they decide to show some strength on that particular day. So just a couple of dates for your diary there. Monday, no flow show. Bran, are you listening? No flow show Monday. And then on the 9th, those two events there, debt ceiling and Russia celebrations. All that's left really is to say take care over the NFP. If you're looking to trade it, the exercise I always do is look at your charts, pick some levels, 50, 100, 150 pips either side, levels you'll be happy to trade. And if the numbers are decent but not game changing, I don't think we will get anything game changing for the central banks, then look for those areas as stretch points where you might want to try a trade. Don't go 5 minutes before the number and think, I think the number's going to be this, and trade that way. You might as well go down to casino and bet. Or better yet, if you want to guess about the NFP, then have a go in our competition, of which I put the link up in the chat room, in the chat here earlier. So have a guess of that. You can win a free month to the ForexAnalytix platform. 3 lucky winners for that one. So trade safe. Thank you for coming to the Flow Show. Hope you have a wonderful rest of the day and a great weekend. And as always, thank you for the great copiers, Kay and Stel, for all their inputs this week. No, but in all seriousness, they do a fantastic job with their charts, both here and knowledge here and in the chat room and everywhere else. So thank you very much to you two guys.
And can I add, Ryan, thank you for your coverage. I think really the depth and the breadth of the stuff you cover within half an hour is second to none. So thank you for being here.
Thank you very much, mate. We'll have to start charging for this, I think. Is that good?
Yeah.
Cheers, Kay. Cheers, boys.
Have a great weekend. Have a good weekend and trade safely, okay? I mean, it's better to miss one than to take it up the lederhosen, as I always say. And as long as there's money in this market flowing around, there will be opportunities.
Exactly. Well said, mate. Thank you all. See you next week.
Bye-bye.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.